Hi, everybody. Thanks for tuning in. Today, we're going to talk about interest rate caps and margins. Now, to start off, I'm going to ask you a question. What has the biggest impact on how your mortgage balance increases with a reverse mortgage? Answer: it's the interest rate. Sure, you knew that, but there's also a couple of other things. The monthly insurance that FHA charges on these loans, that adds up to a significant amount. And also, the bank may charge you, not all of them, but some will charge you a monthly fee. That might be like $30, $40, something like that. But the interest is really the big player. And it's important because interest compounds on these loans. So if you have a $100,000 loan and you add, say, $500 for easy figuring onto your loan in interest the first month, next month you're going to get charged interest on the $100,000 plus the $500 that you got charged interest on. Plus you're going to get charged interest on the mortgage insurance and the monthly fee. So as your balance goes up, every month you're getting charged interest based on a larger and larger and larger number. So that's how the mortgage balances could grow out of hand quickly if interest rates grow too high. Now, I did an example here on the board to kind of explain how this works. When you have an interest rate on a reverse mortgage, and most of them are adjustable, because that's usually, well, on credit line mortgages, you're going to have an adjustable rate. And most of the reverses we wind up doing turn out to be credit lines. Doesn't have to be, but that's another story for another video. And right now with rates so high, you probably wouldn't want to take a fixed rate, because when rates come down, you're going to be very angry that you took a fixed rate of something like 8% as rates come down again. So when we're calculating an adjustable rate, it's made up of an index and a margin. And you add the two together to get the final interest rate. With a reverse mortgage, most of the times, what you're dealing with in the form of an index is the CMT, which is the constant maturity treasury rate. You could look it up on Google and learn all about it if you'd like, but that's just the index they use. Now, you may not have heard of indexes and the CMT, but you probably have heard of the prime rate, which is the best rate banks lend out at. And usually when you're going for a loan or something, you'll hear people talk to you about prime plus 1, prime plus 2. And what that means is the prime rate plus 1 or 2, 3 interest rate points to determine what interest rate you're actually going to be charged. So for an example, the CMT, at the time as I'm making this video, is 5.44%. Then what you do is you add a margin to it. That's the plus 1, plus 2, plus 3. With reverse mortgages, I use the typical margin of 2.75%. So you take the 5.44, add the 2.75, and your interest rate is 8.19%. So what you need to know, and what's important about this, is that the margin at 2.75%, when you're sitting down talking to a loan officer, mortgage lender, and they tell you, well, we're going to give you a credit line and you're going to get an adjustable rate, and right now that's 8.19%. So they're going to say, they're not going to really go into detail about how they come to that number. But it's very important, especially now with rates going through the roof, and how with the reverse mortgage, how the interest compounds, how important it is to know what's going on and to limit how high you don't want your balance to go through the roof. You want it to not do that. So as you can imagine, the banks want to make more money by charging you a higher interest rate. That's how they make money. And believe it or not, oftentimes a loan officer is compensated by the interest rate that he's charging you as well. So when you're sitting with the loan officer and you're going over the interest rate, what do you think he wants to do with that margin? Does he want a high margin or a low margin? He wants the high margin. Now, with reverse mortgages, usually those margins could vary. They could be as low as 2% and as high as 3.5%, 3.75%. That's a very big range. That makes a big difference in the amount of interest you're going to pay. And when you're talking about, if you have this loan for 10, 15, 20 years, it adds up. So you want the lowest margin you can get, and you need to discuss and ask about that. Now, the margin is only part of the equation. Another part of it is how often do you want the interest rate to change? If you have a choice, sometimes it's going to be either monthly or annually. And sometimes the lender's going to have different choices. Now, it's tough to say which do you want. Now, interest rates now are high. Now, if you think generally speaking they're going to come down, you would like your interest rate to adjust monthly so that, well, if interest rates come down next month, you want to be able to take advantage of that. So if your interest rate adjusts monthly, then you get the benefit. If interest rates are going up, you don't want that to happen. So you may want the change to be annually. So if rates are going to come down, you want to say, oh, give me the lower rate this month, next month, and the month after that. So you want the interest rate to adjust monthly. If interest rates are going up, you might say, whoa, give me the annual adjustment. So for the rest of the year, my rate will stay at 8.19 and won't continue to go up. So that's just something you need to be aware of and to discuss with people. Now, a good example of how interest rates change is in 2021, the CMT was at 0.04%, not 4%, 0.04%. So if you add the 2.75 margin to that, your interest rate is 2.79 as opposed to 8.19. Huge difference. Which brings me to the third factor when you're talking about interest rate margins, your interest rate overall, is that there's a rate cap. And you need to ask what it is and what your choices are. And usually it's 5% or 10%. And that's a lifetime cap for the loan. Sometimes they even have an annual or a monthly cap where it can only go up so much in 1 month or 1 year. These are all things you need to ask. Now, just like with the margin, which do you think the bank and the loan officer wants to sell you? They want to sell you the 10% rate cap. Okay? Because they want to make the most money. But you want the 5% cap. The 5% cap, if you, back in 2021, for example, just to show you what I'm talking about. Remember I told you the interest rate was 2.79 back in 2021. If you took the 5% cap, your interest rate, which starts at 2.79, you max out. You add the 5%. The highest you could ever go in the life of your loan is 7.79%. So this month, when you got your statement, everybody else would be getting 8.19. You'd be paying 7.79. Not a huge difference. But what if rates keep on going up? Everybody else is stuck with paying the higher interest rate. Not you. if you took the 5% rate cap. If you took the 10% rate cap back in 2021, your interest rate could start at, well, I forgot the 9, but it starts at 2.79. You add the 10%, you can go all the way up to 12.79. So, huge difference. And how would you even know about these rate caps? You probably wouldn't know. You'd probably say, what's my rate? Oh, that's adjustable. Okay. But all these little things I tell you about make a huge difference in how your loan works and how your balance is going to go up over time. For the most part, when you're over the life of your loan, I think, and a lot of experts agree, that you're still going to build equity in your home. But if you try to limit your exposure to as much interest rate risk as possible, and you get that done, and you get the low margin and the low lifetime cap, you may save yourself and your heirs a lot of money when you're done with the reverse mortgage. So I think that's real important and something to really think about. I thank you for watching this video. There's so many facts about reverse mortgages like this that you need to know about, so please tune into my channel. And every week or two, I'll have a new video on a new factor. And if you want to learn more about it, I put out a free report. I have a hotline set up, a toll-free hotline. Nobody answers the phone, so you can call, leave your name and address. I can mail you the free report. The hotline number is 888-273-1970. You call the line, you hear me talk on a recording, you press 2, leave your name and address, phone number. I'll send you the free report. Or you could do as I recommend. You could hit 3, leave a little bit more information, nothing too personal, and I can send you a little loan scenario, which will tell you how much I can get for you, and it'll show you how your balance will move over time, or estimated, because we really have no idea what interest rates are going to do over the next year, nonetheless, over the next 20. So please call the hotline, get the free report, ask for the loan snapshot. Be happy to do it. Do me a favor, like the video, subscribe to my channel, and hit your notifications bell. That way when a new video comes out, you get to see it too. And if you don't get the notification bell, tune in every couple of weeks, see what new videos I have up. Thanks for coming by, and I look forward to seeing you soon.